Hey, good afternoon, everyone. WPTV anchor Chris Gilmore here in our little digital studio talking about something that affects almost everyone today. It's been in the headlines as we got new economic numbers, the inflation rate here nationally reaching unprecedented 40-year highs. And we've seen after that, just the snowball effect that it's had. Anybody who's been out driving around, you've seen it reflected in gas prices, housing costs, at the grocery shelves. But here to break that down for us is an expert from Florida Atlantic University, William Luther. You're an associate professor of economics there. Thank you so much for joining us and taking time.
Yeah, my pleasure.
So obviously, this is something that has been on your radar for a while. You knew that these numbers were coming out. Did you think that they were going to be this bad? We're at 8 point what now?
8.6. Yeah. Well, I'll tell you. Inflation has been high for the last year. My student and I, Morgan Timman, have been putting out a monthly inflation report since January. So this is something we've been watching very closely. But even still, these numbers are very, very high. Let me give you some sense of how high they are. So before the pandemic, inflation in the U.S. was roughly around 1.7% per year. But last month, prices in the U.S. grew 1%. So we've had what before the pandemic we would consider nearly a year's worth of inflation in a single month. It's just incredibly high.
How much can our economy last in those conditions before we talk about recession, before we have another Great Depression?
Well, there are a couple things to keep in mind. First, we have seen wages grow over the last year, not nearly enough to keep up with the growth in prices, but those wages are going to keep coming up, and eventually they're going to be in line with those higher prices that we're seeing today. So in the long run, in years from now, we won't have lasting effects of this inflation. Eventually, those wages will adjust. That's little consolation today, though, right? Today, we go to the grocery store, we go to the gas station. Everything is just costing more, and of course, our wages and our salaries have not adjusted enough to keep up with those prices. So we're seeing our paychecks not go as far as we expected them to.
I hope we have some CEOs listening, or managers or supervisors, because I'm sure we all got our fingers crossed that we're going to get that call that our wages are going up here soon. I also want to just invite all our viewers on our social media streams to go ahead and take an active role in this conversation. We are streaming live on our Facebook page here on WPTV. So if you have any questions for Mr. Luther while he's here, feel free to ask. He is an expert and can answer them much better than I can. And I'm also taking notes here myself, as this is something that I'm very interested in learning more about. So again, use that chat box to the best of your ability, answer any questions. He can answer them for us. One question I have, just to go ahead and get things started: what's attributed to this hike? Why are we seeing these rates go up?
Well, there are really two drivers of inflation at the moment. Right. The first is the one that perhaps most people are familiar with. We had this pandemic that caused some supply disturbances, and more recently there was this invasion in Ukraine, and as a consequence of that, fuel prices and food prices have gone up. But that actually accounts for a relatively small fraction of the increase in prices that we've seen. If we strip away food and energy prices and just look at the remaining prices, what economists refer to as core inflation, well, that increased by 6% over the last year. So that's also very, very high. What that tells us is that we're not just looking at some supply disturbances. It's not the invasion of Ukraine. It's not supply disturbances from the pandemic. It's something else. And that something else is poor monetary policy. Over the last year, the Federal Reserve has allowed nominal spending to grow far too rapidly. As a consequence of that, we have more money chasing after the same amount of goods, and prices are driven up as a result. And so when we look across the goods and services that are in that basket that the Bureau of Labor Statistics tracks in its Consumer Price Index, we see that more than 70% of the goods in that basket had a greater than 4% increase in price over the last year. That's widespread inflation, and that tells us that it's a monetary problem.
I don't know if you're in the financial advising business, but I mean, what's your recommendation to people? We have people filling up pumps on screen right now. Had people shopping earlier. Advice to people who are just really struggling to make their ends meet right now, scratching to the bottom of their savings account, facing evictions or foreclosures. What can they do?
Well, the difficulties are apparent, and unfortunately, there is no magic bullet. There's no good strategy for dealing with this. It's really a loss minimization strategy, just trying to minimize the damage of this high inflation. So some practical things that people can do. When we look at aggregate data, we see that a lot of people are holding more money in their checking accounts than they typically do. Now, that's partly because they received some payments from the government over the last 2 years, and they're just holding those balances in their checking account. But most checking accounts have very low, and in fact, most checking accounts have paid zero interest. So when inflation takes off, you're essentially being taxed. The balances in those accounts are worth less and less each period. And so one practical step that you can take if you're in this position where you're holding more cash than usual in a checking account is to move those funds to something like a broad market low fee ETF, an exchange traded fund that tracks the S&P 500 or the Russell 3000, some a big basket of stocks. That will give you some yield on that balance, and will minimize the extent to which inflation eats away at the value of those dollars. So,
Okay, well, we'll get back to the stock market in a little bit, but I want to draw our attention to a comment from Tony Letizia, who's watching there at 105. He commented that we need a 10% Fed rate to tame this runaway inflation. Obviously, the Feds have been keeping a close eye on this inflation rate. One of the highly anticipated responses, it will be an increase in the interest rates. Do you think that's more than likely here in this situation?
Well, the Fed has said that they plan to raise their interest rate target by 50 basis points in June and another 50 basis points in July. Markets are continuing to expect that, so I think that's likely. Overall, I guess I should say I'm a little disappointed in Fed policy. They recognized last December that we had an inflation problem. On November 30th, Chair Powell famously said that they were no longer going to use the term transitory, but they didn't raise their interest rate target in February. They didn't in December. They didn't raise it in January. They made a very small move in March, and it really wasn't until May that they seemed to get serious about inflation. And even then, by my assessment, the rate hike that they decided on was relatively modest considering the inflation that we've experienced. So and on top of that, when Chair Powell was asked at the press conference following that meeting if the Fed would consider a higher than 50 basis points rise, he said that they were not considering that. So he's kind of tied his hands here.
How are those bumps going to affect the average American?
Well, we often talk about monetary policy as raising or lowering interest rates, but what the Fed is actually doing is reining in some of the excessive credit that it has created. So when monetary policy is too loose, then banks tend to extend more loans than they otherwise would. And when monetary policy is too tight, they tend to extend fewer loans than they would. since monetary policy has been loose over the last year, we've had, an increase in credit, an increase in spending beyond what was sustainable. And so the Fed needs to rein that in a little bit. And we don't want them to go too far. We don't want them to jam on the brakes and cause a deep recession. But from where we are right now, which is overproducing and credit extended too far, they have to rein that in a little bit to bring this inflation back down.
Okay, I want to toss the comments to Kevin Wagner at 109, asking, what do you feel the effect will be on the housing market locally? We have a Priced Out of Paradise series that we have been ongoing here at WPTV. It's something that's on a lot of our locals' minds as we see the housing market kind of being a little bit of an outlier in terms of the spike that we've seen this past year. How is this inflation going to make things worse? I doubt it's going to make it better.
Well, housing prices here in South Florida, as you know, have just surged over the last year and a half, 2 years. And we're seeing that cooling off. Loan applications for houses are declining. You no longer have to make a huge above market, above ask offer in order to close on a house as you did just a few months ago. So that's starting to cool off. Now, of course, if you own a home in South Florida, that big boom in prices is great for you. The value of your wealth has gone up. But if you don't own your home, if you're renting or if you're looking to relocate to South Florida, then those prices make it very difficult to do so. So I think that it's likely that housing prices, the growth in housing prices is going to slow down, but we're going to see broader price increases in the market as this inflation continues.
Okay, William, another good question coming from Phoenix Parker Cruz, because I know you were just talking about ETFs and the stock market, and that leads us into our next topic of how the stock markets responded to the changes today. But he's asking, why would somebody place money in an ETF with such an unstable market? I can see if you have a surplus of cash, but I think most people are not in that boat. And we've seen that reflected in the stock market numbers really crashing today.
Well, there's certainly a lot of uncertainty here with the stock market. But as part of a long-term portfolio strategy, if you're holding a broad basket of stocks like a broad market, low fee exchange traded fund, then over longer periods of time, this is going to have a pretty decent growth rate, and will offset some of the inflation that you would otherwise experience. Of course, if you need access to those funds in a month or in 2 months, then that's not a very good strategy for you. But again, as I said, we see checking account balances are incredibly elevated at the moment. A lot of folks are just sitting on more cash than they typically would, and there's not a good reason to do that right now, considering that inflation is so high. So if you are sitting on more cash than usual, then you should probably look to ways to reduce that cash, because the rate that you're going to get, the real interest rate that you're going to get on that cash is negative, because inflation is going to be surging here.
As far as like people's stock investments, though, William, this isn't the first time in recent history over the course of the pandemic that we've seen the stock market crash. It was I forget which year, but we saw that incredible crash where people were similarly freaking out as they are now. Mm-hmm. Is it not the appropriate response to pull out your funds? I know a lot of people worried about their 401ks and things like that too, on top of ETFs, as you were mentioning.
Yeah, the best advice I can give to someone who is looking at their portfolio balance decline at the moment is stop looking. What we see in the data is that people who trade more frequently, particularly trading on news, they tend to experience lower returns than people who just set it and forget it. What you need is a portfolio strategy I would encourage a low fee broad market ETF, and then you just hold that for the long term. And when you hold that for the long term, you'll realize a market rate of return, and you'll avoid those ups and downs, because you're not trying to time the market. So try not to look at your account right now. Just trust that, in a year or so, that market will have recovered, and your retirement savings will be back to where you expected they would be. Just let those short-term disturbances pass by with as little attention as you can give them.
Okay, William, we see the stock market charts, and we always see the peaks and valleys, and it's cyclical. So with that understood, is now the time to invest heavily now that we know that things will rebound eventually?
Well, it's hard to say, how low these prices will go. In much the same way that I would say that you should focus on buying and holding assets over a long period of time, you should also have a strategy for making regular purchases. What's sometimes called a dollar cost averaging strategy. So, just choose a day of the week or a day of the month, and every week or every month you purchase a little bit of your portfolio, and you just keep doing that, whether the market is up or whether the market is down. Just stay that course, and any fluctuation that happens there is going to more or less cancel out over time, and you'll be left with the market rate of return, and you won't have to worry too much or follow the news too much about what's happening today with the particular stocks. Just follow that trusted strategy, and you'll fare reasonably well.
Okay, so your expert opinion, it's not a sprint, it's more of a marathon when it comes to stocks. One more time, your advice just in response to inflation and us continuing to be pinched here. You said, according to what you've seen, people spending more smartly, budgeting tighter, and thusly having more money in their checking accounts. Is that the continued recommendation?
Well, of course, there are some things that people can do, in particular with how they spend their time, and they might be able to shift their time. So we saw during the pandemic, for example, travel plummeted because of the risk of COVID. People thought that is not the time to take that trip. And as that pandemic eased up, we saw that travel recover. And now we're seeing travel costs really soaring. And so now might not be the best time to take that trip either. You might want to delay that until next year, and pay much less for it than you would if you were booking that in the next month or so. Much the same thing with energy costs. We see that energy costs are especially elevated right now. They were up 11% in March. They came back down a bit in April, but up another 3.9% in May. And so, to the extent that you can reduce your fuel costs, that would be now would be a good time to do so. Try to make fewer trips to the grocery store. If you're able, arrange a carpool to work. Just think a bit more about the trips that you're taking, and try to cut some of those out if you're really bumping up against your budget there. Right. So just some minor things. Again, they're not going to help as much as we would like them to help. It's a very difficult situation, but they will help a bit, and every little bit counts.
All right, William, we're getting close to 20 minutes here. We covered a lot of ground in a short amount of time, but we no stranger to storms here in South Florida. This seems like another one we're going to have to weather. Any other final thoughts before we let you go?
Well, the good news is that this isn't going to last forever. Over the last 40 years, we've had relatively low inflation in the U.S. Inflation came down, relatively quickly under the Volcker Fed, remained low under the Greenspan Fed, under the Bernanke Fed, the Yellen Fed. Right now, we're dealing with some difficulties, but we recognize those problems. That inflation is going to come back down, and so we're just going to have to weather that storm until then.
All right. William Luther, Associate Professor at Florida Atlantic University. Thank you for your time. Thank you, everyone watching as well. If you want to recap this segment, you can go ahead and catch it on our social media pages, including WPTV on Facebook. Thank you so much.
Thank you.